Yes, thank you very much. And first of all, good morning, dear Sergio Balbinot, dear Michaela. It's obviously my pleasure to again be your guest at this European Insurance Conference here in Malta. Last year, ladies and gentlemen, last year in Rome, I promised that I will return next time when the Omnibus II directive has finally been concluded. And of course, I'm glad that we all, Karel, that we all delivered in November last year. The European elections passed only 2 weeks ago, and the European Parliament is currently in process to prepare its reconstitution on the 1st of July. I've heard that Malta again had a high level of voter participation, 73% in the elections. This is a good sign for Malta. However, unfortunately, not representative for many other member states where the turnout of voters reached historically low levels. Furthermore, the voting results are marked by a considerable increase of anti-European or even Eurosceptic parties. Both developments are a wake-up call which we cannot ignore. European politics finds themselves again on a test bed. The new European Parliament will be a place where the majorities are not as flexible and as evident as they have been before. The quality of the political and legislative content will be more decisive than ever. The outcome of the elections also has an impact on the working relations with the other EU institutions. They will face a parliament that will even be more vocal and critical than before. But still, the majority of voters decided in a pro-European way. During my electoral campaign in the last weeks, I had the opportunity to get in touch with many citizens in my constituency in northern Germany. They had questions, they expressed their concerns, and during those 5 weeks of intensive campaigning, they approached me by addressing in particular the following 3 topics. First, the peace-building role of the European Union, which is of crucial importance in the present Ukrainian crisis. Second, the negotiations on the transatlantic trade and investment partnership, where European interests and consumer standards need to be preserved. And thirdly, the stability measures for the Eurozone and the regulation of the financial markets that both help to foster a financial system where budgetary discipline counts and where financial institutions are set liable for their risk-taking, not taxpayers and consumers. These examples, ladies and gentlemen, have one thing in common. Whether we are able to achieve the best possible result depends on whether we achieve a common and strong European understanding. One benchmark for the Europeans is their global competitiveness. The setup of regulation, its coherence and convergence is a key factor in this regard. A common European understanding on the future development of the regulatory system for the insurance and the reinsurance sector is essential. And this is why I very much welcome today's exchange of views on the challenge of a developing global regulatory environment and definitely on global insurance trends. Around 3 weeks ago, we have seen that the Omnibus II directive the amending directive of Solvency II, has been published in the official journal. The technical specifications are still in progress. The Parliament expects the Commission to present the draft delegated acts as soon as possible to ensure that there's sufficient time for scrutiny and for the finalization of the legislation until its implementation until end of March next year. Having the lengthy and difficult European legislative process in mind, it raises concerns that additional capital standards might very soon be created on a worldwide level. My concern is certainly not based on the fact that there is a dynamic international development in insurance and reinsurance regulations. The lessons learned from the financial crisis directly point to the interdependence of markets and their financial players, not only in the European single market, but also on a global perspective. Capital is fluid and is looking for the best profitable result, non-dependent of geographic borders. It is therefore necessary that we progress on international convergence in the regulatory provisions and the supervisory practice. Even though with Solvency II, we will soon have a sophisticated European legislation in place, and I'm sure we all agree that systemic risks need separate consideration. The timing perspective with 2014 for the development for basic capital requirement on globally systemic important insurers and 2016 for the development of international capital standards for internationally active insurance groups. This timing perspective, however, seems to be rather ambitious. We have seen how long the Basel process in banking has taken, and Solvency II needs some time to run. It tackles long-term risk, and any adjustments in the legislation may only be evaluated in mid-term or long-term perspective. But to give here a clear message, from a European side, there is certainly no appetite for an early review of the rule book that we just agreed. And I see Karel van Hulle laughing, so I'm quite right, I think. It was already a tremendous work to come to solutions with the 28 member states, having in mind their national specificities and different structures of long-term products. And how are we supposed to effectively agree and implement on an international level here? Do we then end up with a minimum solution, a so-called least common denominator? If this is the case, is there a real added value to put additional burden on undertakings that try to stand their ground in the international competition? I know I deliberately exaggerate at this point, but however, the cost-benefit analysis raises some questions. The envisaged framework of home and host supervisors already addresses possibilities for supervisory engagement if risks are not appropriately addressed. And to add capital for systemic risks means that we focus on the capital side, where we face different calculation methods across the globe. This probably leads to additional complexity in the international negotiations. And in the end, it is certainly not in our common interest that undertakings have to fulfill various sets of capital standards that are not even linked in their basic methodology. Coherence with the Solvency II principles is therefore absolutely necessary. And I hope that the field testing exercises will provide a better clarity in this regard. Ladies and gentlemen, I've already called upon the Commission and EIOPA to remain strongly engaged in the regulatory dialogue with our international partners and to further promote the ideas that are set out in the Solvency II legislation. Coming back to the comparison with the Basel process. With Basel, the starting point was a different one. The initiative was primarily driven by the international side. The Europeans then started to transpose the Basel standards in EU legislation that was far more reaching than the international agreed provisions. For insurance, the development seems to be reverse. We will have a very sophisticated piece of legislation in place before the IIS and the FSB system will be further developed and finalized. That is why I remain even more cautious. If we move ahead in the direction of global capital standards for insurance, we should also underline the specific business model of the sector that is definitely not comparable to banking. If we follow the Basel way, there should also be a transposition to European legislation at a certain point in time. Speaking very forward-looking, a review of Solvency II and, of course, CRD4 in banking might include ideas to address systemic risks and, in particular, internationally active and systemically important groups. This will be one possible way to safeguard the necessary democratic accountability in the process. I do not want to act as a prophet in this regard, but Solvency II has taught me definitely one lesson. It is wise to be rather cautious with forecasts. One message, standard setting, ladies and gentlemen, standard setting that affects European undertakings and groups has to be developed with an appropriate involvement from the European side. An appropriate consultation process of the European institutions and stakeholders has to be guaranteed. As European Parliament, we will have to say on the Solvency II equivalence decisions for third countries. This includes an approval procedure of the draft delegated acts that the Commission presents for determining an equivalence status or a temporary equivalence of third countries. As regards reinsurance, consolidation, or group supervision. From the Parliament's side, there's therefore an even stronger interest of being appropriately involved and regularly informed about the international development and about the convergence towards common regulatory and supervisory approaches. Further motivation is given by the current negotiations on the transatlantic trade and investment partnership. The European Parliament wants to see financial services matters on the negotiation table as well. At present, the question of third countries is tackled by every European directive in a separate way. European legislation generally provides for the acknowledgement of equivalence, but the conditions to determine and to achieve equivalence vary to a considerable extent. The negotiations on TTIP might be an opportunity to clarify basic principles on market access with the Americans, our main partner and counterpart in the financial services domain. This idea would also account for the insurance and in particular for the reinsurance sector, where questions on collateral are still to be solved. Ladies and gentlemen, there's movement in the international dialogue. However, alleviating concerns from the European side will only be feasible with a transparent approach that gives the European institutions and the stakeholders a comprehensive set of possibilities for a strong involvement. I doubt that the current framework already provides for such possibilities to an adequate extent. The dynamics and the rapidness of international regulation are new for the insurance and reinsurance sector and for the institutions involved. There's a bundle of so far unanswered questions. When will the timeline be specified? How might the specific responsibilities and tasks be organized? It is possible to agree on appropriate valuation methodologies. How will the field testing be managed? What will be the status of the capital and loss absorbency requirements? How do they fit into the existing legislation? How might the governance of the international system look like? And what might be the steps of supervisory intervention? There are certainly many more questions, but some questions might be addressed within the next months. As Europeans, we should take advantage of this ongoing process and underline our understanding of international standards for the insurance and the reinsurance sector. The heading of today's conference is a challenge of change. Change has positive and negative attributes. In order to have a say on how change will develop, we need a strong European voice. It will also help the Commission and EIOPA to have the European Parliament on board. The European Parliament supports that an international debate on the global interconnectedness and systemic risk in the financial sector has been launched. The debate will certainly continue on the agenda of the new Economic and Monetary Affairs Committee in the European Parliament. And in the end, the European undertakings that are affected and our global competitiveness, it is at stake. This is, ladies and gentlemen, why we need a proactive approach with all European players and stakeholders involved. And therefore, I count on you, I count on the European Commission, I count on EIOPA, Gabriel, and of course, all of you from the companies of the insurance and reinsurance sector. Thank you very much for having me here today, and it was always a pleasure to come in the last years to a European conference. And from my side, I can tell you that I would like to come back in the next couple of years to your European conference. Thank you very much.